Now, as a quick follow-up to the previous video on anticipating highs based on understanding the negative divergence, so let's take a look at an example here. And of course, in this particular example, our 69.1 level is somewhere there. All right. Now, while I'm here on my drawing here, something else also when looking for exits, I need to start talking about this because you see this a lot. Be on the lookout for instruments that are rejected as they try to move above 69.1. So look for exit signs whenever an instrument is rejected. When the RSI tries to move above 69.1 and there's rejection with uniform activity. In other words, for example, here we can see it was flat, and then was rejected down. So this is uniform activity rejection. Any type of uniform activity rejection will work. But whenever you see the RSI being rejected at 69.1, generally that means that there's a dependable short-term high that you can use for as an exit signal. So, but here for the sake of this example, we're going to be looking at the anticipating highs again when the RSI makes a lower high and prices had made an improved highs. Let's take a look at that example I just observed while I was looking at charts. And here we have SMG. Now it doesn't matter what the instrument is, it's just one that I saw while I was still on the topic. I want to show you the negative divergence we are talking about. Here we had an improvement in price highs. There, take a look at what the RSI did. You got a lower high, so that negative divergence led to some type of a meaningful drop after that, right? So we understand here that this stay above 69.1 was not the high. So you can sell some, but understanding because you spend some months, this is a monthly chart, above 69.1, chances are that you'd be coming back to make a higher high with negative divergence, and that would be the ultimate high. And here, good evidence. You spend some time above 69.1 for the highs there. You pull back. Ultimately, the high comes on lower negative divergence. Down, up. We see the same type example here. We spent some time above 69.1 here for those highs, but those were not the main highs. Yes, it led to a pullback, but ultimately you need to understand this. We would come back to record higher highs, and it took many months for this to be achieved, but this came with declining technical strength, and that was the main high there before this significant multi-year drop. And even recently, we saw that we spent some months here above 69.1 for those highs. We come back and record a higher high on price and a lower high on the RSI. That negative divergence led to this shallow drop. And again, we come and make another lower high, and we go on higher and another lower high. So in other words, during all these highs here, they were lower. That was the RSI above 69.1, and then all these highs were lower, but they correspond with higher price levels. And that is consistent with when the RSI finds support and moves higher. In fact, I discussed this concept in something I call the Muathe RSI foreplay. It's a known behavior that stocks do, and I hope to cover this in the upcoming weeks, but that's just something that is known, that when a stock does this type of formation, that is the warm-up play, and that ultimately you're going to be moving higher. So all these are warm-ups. It's what I call the warm-up. It's a stock telling you of its intention. Here the same thing. And so every time it coils back, this tends to be a sign that you're going to have to see higher highs. So again, we see here highs are not the easiest thing to time because it depends on your time frame. If you had, for example, if you are looking to own the instrument for 2 weeks, then timing some of these things are hard. If you had 2 months, for some reason you need to get out of that position, then you see these things take time. And if you had 2 years, it's a different conversation. My point is, highs are not as easy as entries. It is, let's think of it this way. It is easy to identify when a relationship began. Let's say your employment, you got a job somewhere, right? So you know when the employment began, but it is hard to know in advance when you're going to make an exit out of that position. So some exits are not as obvious as entries. Or let's put another way. So everybody knows their birthday, but you don't know your exit date. So exit's a little bit tricky. So and that's just how it is. We have to accept that for what it is. So if I was to stay on task here, let's take a look back at my graphic. That's the graphic. And so that's negative divergence that helps us anticipate higher highs. So let's take a look at the current chart. Right now, the stock's been spending a lot of the last couple of months above 69.1. In fact, let me zoom in. This is all data monthly. Let me go to 3 years monthly and you'll see this. So over the last couple of months, since about middle of 2016, during this breakout, quality breakout, I must add, which is the reason why the stock exploded from about 71 to the highs here of 98, 90, 99 and change, somewhere in the higher 90s. RSI has held above 69.1. So what does this tell you if you own this instrument? We can anticipate at some point it's going to pull back, try and move back above 69.1, which might suggest higher highs in the coming months at some point. Now, I always want to make sure that I reinforce this idea of quality breakouts. And so we're talking about this period here when the RSI jumped above 69.1. We also see that it corresponds very nicely with RSI moving to 3-year highs there. MACDs were moving to 3-year highs. So the stock definitely met the minimum requirements, no question about that. That's why it has gone on a good run. Ultimately, this is always what we are looking for. But since this is exit strategy, let's go back to that strategy here. So even if you own this, you know that with a pullback, since we've spent so many months above 69.1, chances are even with a pullback, at some point this stock is going to be trading above the 100 price range, because a pullback does not mean it's the high. Any pullback that is, let's call it shallow, the RSI gets a shallow pullback and moves higher, that would suggest higher highs. So we can anticipate higher highs based on the amount of time we've spent above 69.1 on the monthly chart here. Now keep in mind this works on all time frames. We are just using the monthly chart. In fact, let's take a look at the weekly on this example. Take a look at this perfect example. You move above 69.1, you make fresh highs here, but you recapture the level back above 69.9 again, you make fresh highs again. So you do the same thing back above 69.1, you go on to record fresh highs. This goes on and on. Every time you recapture 69.1, it means new highs. So you can see here now that it's moving back below 69.1. If it coils back above 69.1, definitely gonna be going to fresh highs. That's gonna be a given. At the same time, if, let's take an example here, if it coils back, is rejected at 69.1, chances are you're still going to test the highs here or even make fresh highs. So that's when we might get that negative divergence look, which might lead to a strong pullback. We take a look at the daily just for the sake of what the daily is trying to show us here. Daily still continues to look good. We've been bouncing on this 50 RSI level on the way up. We are still holding another potential bounce. You can take a look at the daily. The daily chart is coming back to test this. We can draw this RSI lows line as an example. Take a look at how this is so perfect. Stocks have an amazing level of memory. So we are coming to find support there. So if you own this based on monthly strength and you know that it could continue being strong, this is where you take up a position, maybe buy back. So let's say you had 100 shares here. You sold 20. You have 80 left, right? You can buy back 10 shares based on this support line to see whether you sell this above 100 because of the strength of the weeklies and the monthly charts. And also we can see that off the lows here, which is this RSI entry, we can use that information. So that entry there can also be used to determine bounce territories, and this stock has been responding perfectly on this level. Uniform activity bounce, triple bottom there for those lows. Uniform activity bounce back above the green line for those lows, and now doing the same thing. So if you are trying to find an exit here, you can see that as long as it is holding this daily support line, chances are that it continues to bounce and might go on to record a higher high. Now if it breaks this line, maybe that would cause somebody to sell a little bit of their remaining 80 shares in our example, but it's holding support right now with the strength on the weekly and the monthly. If you're looking for an exit, this gives you pause to wait for higher price levels now that it is coming back to find support on those two lines. And don't forget support at the upward sloping 50-day moving average. So let me end this example here. Otherwise, we'll keep the conversation going on exit strategies. Eric Muathe with Muathe.com. As always, good luck, peace, and blessings. E-A-C-S. Woo!